Whoops. I missed that. It should be this way. Well, you guys know it by now. Yeah, I continue to be consistent in screwing up all the cameras and intros and everything else. But today, interesting one for you all. Thank you all for being here. Although the title does sound interesting one for you all. Thank you all for being here. The audio, there are going to be a ton of secret lessons in there for you guys who are all either professional investors or newcomers to the space. And while we are up to our ears in FUD, crypto is flat. Bitcoin is so flat despite all of the stuff being thrown at it. Like Bitcoin, it's remarkable. That is what I call relative strength, literally. But we're going to take apart a very important aspect of investing called value investing. And we're going to go at it from a whole bunch of different angles. And I'm going to share tons and tons of learnings to you all. We're going to look at valuations. We're going to look at relative values. We're going to look at values over time compared to other types of assets and indices. We're going to look at how to determine if you want to be in something or not, if it's bad to hold cash as an investor. That's an interesting one, and the correlation between performance and holding a lot of cash, etc. We're also going to, look at biases, very important. The video today, I've been thinking about for about a week. It was going to be about psychology and biases, but I ended up going down another path. And that sometimes happens. And not many are interested in the psychology of investing, but this has a lot of it in it too, where we all need to examine our biases on a daily basis. In addition, there's another thing is, don't listen to what people say. Look at what they do. So if anybody can accumulate all of the learnings in this video today, drop a comment below and I will read every one and I will pin the best answer to the number of lessons. So first of all, not financial advice. You guys know the drill. And again, as I mentioned, the story basically, a lot of people have criticized Berkshire Hathaway. They are the kings of value investment. And they've done a remarkable job over 50 years or more. But between, say, the last 20 years, last 10 years, the Berkshire Hathaway index has lagged the S&P 500. And why is that? The S&P 500 has done about 14.3% per year on average over the last decade or so, whereas Berkshire have only done 13%. So not too good. And it's worth noting as well, they do have a very long track record of performance, and they are the best value investors in the industry. But this is a story of if it's still a relevant way to invest today. And we'll dig into some strange behavior. So first of all, we're going to talk about Charlie Munger. And again, my hat is off to him. He's 99 years of age and he's still working his tail off. He is still doing TV interviews. And that's impressive. But what makes him so special, I think we can all learn from this, is their whole plan in value investing was finding high quality businesses with strong competitive advantages and holding them for the long term. Also, partnering with people like Warren Buffett. Those two have a very good synergy together and have been business partners and close friends for 50 years or so. But their partnership helped them support each other, strengths and weaknesses, to build a highly successful investment firm, Berkshire Hathaway. And they have a ton of knowledge. In fact, digging into Munger, I didn't realize he had skills in economics, psychology, philosophy, and history. Remember, psychology, very, very important. And he also focuses on continuous learning. One of the things I emphasize as well, never stop learning. Be a shark. Continue to learn every single day. And Munger is a lifelong learner, which is cool. He's also very patient and very disciplined, which is good. But there's a twist there. And that could be patient and disciplined, key issue here, sticking to his investment approach and maybe not evolving as fast as he should. But we'll dig more into that later. That's kind of what made him special. But let's dig into BYD. Now, BYD is the number 2 car maker probably on earth after Tesla in terms of speed of growth and adoption, heavy player in EV. But BYD also make a lot of hybrid vehicles too, and a lot of very small cars like golf carts and things. But why did Munger invest in BYD? I don't know the exact reason, but I guess based on the different things I read. First of all, Charlie Munger always liked Chinese companies, and because he looks at politics, he looks at growth, he saw China as a growth market, and he saw BYD back in the day, 2008, it was very, very cheap value. So it probably hit those two boxes. Also, he was interested in ESG and environmental sustainability. And they liked Wang Chuanfu, the founder of BYD. And he described him as, I can't remember the name, but combination between Jack Welch and the guy who built the light bulb. I should write this stuff down. I can't remember. Anyway, that was kind of his hybrid. And at the same time, Charlie Munger was meeting with Elon Musk from Tesla. So it's kind of weird. And that's kind of what triggered a lot of this interest too. But they also looked at undervalued companies, very strong growth potential, etc., etc. So that's why they invested in BYD. And there's a method to this madness too, because we're going to analyze a whole bunch of stuff. But first of all, let's look at their BYD holdings today. And this is important. You can see Berkshire Hathaway today own about 4.49% of BYD, 130 million shares. And you can see the founder has 18%. Zhang Yang has about 8%. So nearly 30% is held by two kind of insiders. And then a third insider down there with about 3%. And BlackRock, 2.5%. It's kind of interesting mix of investors and holders. But 13, 14 years ago, Berkshire Hathaway bought a truckload. But we'll analyze as well what they've been doing since then. Now, what really, as many things got my attention here was Charlie Munger said BYD was his best investment at Berkshire Hathaway. Okay, 50 years doing the job, and he said that was his best investment, so we'll analyze that. But he said it's also almost ridiculous in how much it's beating Elon Musk. In fact, this is kind of what triggered me, is today's video is sponsored by White Tea. You can see Charlie Munger there with his can of Coke. They have a huge holding in Coke. We'll talk about that in a minute too, but you can see it right there visual on the TV. But Charlie Munger said BYD is so far ahead of Tesla in China, it is almost ridiculous. And at the same time, he is pumping BYD stock, but dumping it. And this is part of what got my attention. It's like, okay, he's saying like the sun shines out of BYD, and at the same time, ditching as quickly as he possibly can. So we'll see. Let's look at the ditching, the dumpage from Berkshire. You can see here with regularity, every couple of weeks, boom, 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 sell, sell, sell. Huge amount. And they only have 130 million shares left. They had about 240 million. So they've sold over half. Now remember, one of the very important lessons as well, we've covered a few already, but watch what they do. Do not listen to what people say. Watch what they do. So if you're listening to one of those CNBC, whatever, MSNBC, Yahoo Finance interviews, you'd be very misled. He's saying best company ever, far outshining Tesla, but he's dumping all the stock at the same time. Ooh, but let's go back in history here. This is really the interesting piece too. Another lesson coming up. This is from Elon Musk. He was at lunch with Charlie Munger in 2009. He's trying to raise money for Tesla. Where Charlie Munger told the whole table all the ways that Tesla would fail. And Elon was quite sad and disappointed he wasn't successful in raising money from Charlie Munger. And at the same time, Charlie Munger was in bed with BYD a year earlier and made a big investment there. So that was interesting. But this is another lesson coming. This is the delta in Elon and Munger. I call it the most expensive lunch. Charlie Munger could have thrown $250 million easy at Elon Musk and would have made a lot of money, or even a lot more than that amount. But this is the Elon Musk thing. I was at lunch with Munger in 2009. The price, I estimate, of Tesla in 2009 was about somewhere between 70 and 80 cents. I could be off, but it wasn't fully IPO'd yet. So there's a few little estimates here. First of all, let's look at BYD, their performance of that stock under the reign of Berkshire Hathaway. It's up 1,953% in that tenure since 2008, which is very good. Call it a 20x amongst friends. Pretty amazing. But Tesla's up 152x since the 2009 launch. And that is staggering. And again, depends on how you measure it. If you're taking a 60 cent or 50 cent deal that Berkshire could have potentially gotten in 2009, that would be a lot more. But again, just making the point here regarding some of these numbers. Now let's talk about what would have happened to Berkshire Hathaway. This is also very important because it looks at Berkshire Hathaway's performance if they didn't have BYD or if they had also invested in Tesla. So here, the Berkshire Hathaway results from investing in BYD it added about it currently is worth about 0.91% of market cap. But they made, per this simple analysis, because I read somewhere that they invested $230 million. They bought 225,000 shares. That's $1.02 a share. And the market cap of Berkshire Hathaway today is $682 billion. The return, if held everything, and they didn't, would have been about $6.2 billion. So about just less than 1% of the market cap. So it wouldn't have been completely game-changing, but again, substantial. Now, what, instead of 0.9%, if they had put, say, $250 million into Tesla, what would they have gotten? 230 million, not 250 million. They would have been able to buy at least 255 million shares. And that would bring about an increase in market cap of about 6.82% to Berkshire Hathaway if they held. And that holding today would be worth about 46 billion or over 20,000% return on investment. And that is kind of stunning. But why does that matter? So before we go into the actual results of how Berkshire has performed over the last 20 years and 10 years, etc., let's look at what we need to examine ourselves as investors. I need to check my biases every day. That's why I don't trust myself. I trust models and data points. They make all the decisions for me, not myself. You can't be trusted. But numbers can. So let's look at the biases that people can have when it comes to investments. And I looked at this from Charlie Munger and Berkshire Hathaway's perspective. So there are many, many different biases. I listed some of them here. Some of them you may be familiar with. But again, get familiar with these because they are important to know. First of all, loss aversion bias. This refers to the tendency for investors to experience losses more intensely. And that can turn them off investing. Basically, they become very, very fearful for fear of losing. Okay, now it's good to be fearful, but not too afraid. And this can lead investors to holding on to losing investments for too long. It can also lead them to avoid jumping into investments for fear. As we know, yes, Charlie Munger described all the ways that basically Tesla was going to fail, but they underestimated Elon Musk. Second is confirmation bias. This is the tendency to seek out information that confirms pre-existing beliefs or opinions while ignoring or discounting evidence that contradicts them. And this can lead to poor decisions. It can lead to overvalue things like positive news, undervalue negative news, which can result in poor investment decisions. In fact, if you look at what's being on the TV and newspapers and magazines today, you would swear when you look at certain names and the type of articles that are coming out about that the world is going to end. But they're just FUD. And you cannot look at this. So this is kind of an interesting one as we go forward. In addition, there is confirmation bias. This is the tendency to seek out information that confirms pre-existing beliefs, opinions, while ignoring or discounting evidence that contradicts them. Very, very important. We always check our confirmation bias. Then you have overconfidence bias. This can be a tendency to overestimate their own abilities of knowledge or expertise or trust in others too much in terms of saying, oh, token X or stock Y is going to go to the moon. Yeah, that can be very dangerous. Then you have the herding bias. For example, when all the herds and all the armies go in a certain direction on, say, Twitter or other places or in the media, this bias occurs when investors follow the actions or opinions of a group without questioning them rather than making independent decisions. One of the reasons I don't look at a lot of stuff and read a lot of stuff other than trusted sources is I don't want to get that herding bias. I'd rather blaze my own trail. Anchoring bias. This occurs when investors rely too heavily on the first piece of information they receive and ignore all the rest. And then recency bias. This is the most recent piece of information they receive and ignore all the rest. So again, watch that. But when I analyze the Berkshire Hathaway decision, they really only had that loss aversion bias. And that's typical with value investors. And that's why they walked away from good opportunities like Tesla. Anchoring bias, perhaps. Again, the anchoring bias is when the investors rely too heavily on the first piece of information they receive and they don't change their mind. They don't reassess their theses. They don't look at the performance of a certain stock over time and say, 2 years later, maybe it's different. Maybe it's worth revisiting, or 5 years later, or 10 years later, or even 13 years later. Nope, they stick to their guns, and that can be very, very fatal in the investing world. So let's dig into some more numbers. This is Berkshire Hathaway over the last 22 years. The black line is Berkshire total return, and the blue is the S&P 500. You can see when the blue is above the black or higher than the black, it means S&P beat Berkshire. And over the last 22 years, Berkshire only beat the S&P 9 times. And what's also very interesting is when you look at the huge hoardings of cash that they sometimes have, is there a correlation between those years where they have a lot of cash holdings? Like here, I will show you. Every year they had very high cash balances. They underperformed the S&P 500. And you can see some of the key years there, like 2015 was a classic example. A lot of cash going into 2016, and then completely underperformed, and then started blowing all the cash real fast and investing hard. And then coming out of C19, they moved to a lot of cash, and that was actually a great time to invest as well. And then they started investing in things like oil companies. So be on the train is indicated by these numbers here. It's better to have money working in the market than sitting on the sidelines. Of course, if you can time a black swan event and be out just in time and then get back in cheap, that works too, but it's harder to do, especially when you're moving around billions and billions of dollars. So let's look at the performance of Berkshire Hathaway, and we'll start getting into individual holdings that they have in a second too. But this is super interesting. Over the last 14 years, so I went back to the time that they first invested in BYD. This is the Berkshire price divided by the S&P 500. And over 14 years, they are flat. In fact, they're tiny, tiny, tiny little bit negative. And that is stunning. 166 months, 13.83 years, underperformed the S&P. And if they didn't have BYD, they would have underperformed a little bit more. But if they didn't buy Apple stock, they would have gotten crushed entirely. Apple stock completely saved them. If they had invested in Tesla, they would have smashed the S&P 500 by 7%. So that is kind of the importance of, even if it's a very small holding, the impact of getting involved in a disruptive stock can make a huge difference. Let's look at the earnings for Berkshire Hathaway going forward, projected out to year-end 2023. You can see that earnings are crashing. They're going to go negative for the first time ever. And that is kind of stunning, minus 7.6% profit margin. But why is that? Why are they all of a sudden starting to lose crazy amounts of money? Well, let's look at what they hold. And basically, when you invest in Berkshire Hathaway, you might as well think of it like buying half of Apple. So, and the rest is kind of oil, traditional finance, and junk food. Oil, we all know where that's going. TradFi, we also know that's going to be disrupted. And junk food, well, it causes diabetes and kills some people. So I'm not a big fan of any of their holdings. And these are just the top holdings that represent pretty much 95% of everything they have. But even if you just add up Apple, Bank of America, Chevron, and American Express, that is over 75%. Coca-Cola, then you go up to over 85% of their holdings in five names, which is also kind of interesting because there is one parallel between me and Berkshire Hathaway and Warren Buffett, who I've been following for over 3 decades. Again, very impressed. But the thing is, I am typically heavy in 3 names: 1, high conviction, and 2, ancillary names. And that is not too dissimilar from what I do. So that is one thing. The question is, what are they holding, and does it make sense? Let's look at Apple. So here, this is today, 2023, and the projection for 2023. They expect sales and earnings to fall. And if Apple didn't spend so many billions in buying back their stock, the stock wouldn't have performed. Remember, sales revenue for Apple was only growing 6% over the longest period of time. Now it's beginning to tank. And if they don't get kind of a shot in the arm from the new VR headset that they're building, they're going to shrivel up over time, that's for sure. But that is half of their bag. Let's look at the second biggest holding, Bank of America Corporation. You can see here, earnings are flat. Growth, tiny bit up to 2024, and then flat. And then crypto will disrupt the hell out of Bank of America Corporation. Remember, these banks, they give you 0 in your deposits, and they charge you a ton to lend you money. That's the whole business model. That's all going to go away over time. No doubt about that. Chevron, let's look at the oil company. Whoa, this is nasty. This is a bit of a death spiral. Revenue going to tank for the next couple of years out to 2026, and so are earnings. Wow. So the key thing here is obviously, despite their so-called value stocks, none of their big holdings are growing. I even looked at Coca-Cola and American Express. It's a horror story. Anywho, let's get back to this guy, 99-year-old Charlie Munger. I believe he is a stud. I would love to be around at even 90, never mind working. I would love that. But I mean, he's still doing it. And he has the funniest quotes on earth. Literally. I love this one. If we mix only a moderate minority of share of turds with the raisins each year, probably nobody will recognize what will ultimately become a very large collection of turds very soon. That same expression you can take back to how the banks operate. They take your money, they sit on your money, they give you nothing on your money and charge your ton to borrow money. And humans are just accustomed to it. It's like 5%, 10% inflation every year ripped out of your back pocket. People are just accustomed to it. And that's where this, I love this turds and raisins analogy. It's brilliant. So let's go to the conclusions real quick. Is value investing dead? And don't forget, everybody, let me know how many learnings you got for this, because it's full of valuable life lessons in here. So again, value investing is a long-term strategy that involves buying stocks that are value. They're priced below their intrinsic value, i.e. they're cheap. But sometimes, as we learned, they're not growing very fast, and that's why they're cheap. So the strategy, again, used by the king of value investing, Warren Buffett, and his partner in crime, Charlie Munger. So the conclusion, in the time that I believe we are in of exponentiality, exponential technological change, disruption, is clear that value investing is not a viable strategy. What I mean by that is we are entering, I was chatting with somebody today about the medical advancements that are happening right now, where people can, with CRISPR technologies, fix, long ailments that people have. And that has never happened before. We will see more advancements in medical over the next 10 years than we have in the previous 100 years. No ifs, ands, or buts about that at all. In addition, disruptors that make a profit with a durable competitive advantage and be flexible in the definition of value could be construed as value investing. An example of that would be Tesla. You look at not necessarily their PE of 40 or 50, depending on what source you use, but look at the earnings growth, look at the roadmap, look at the revenue growth. That is technically, when you fast forward 1 year, 2 years, it is a value stock. In fact, the price to earnings ratio of Tesla when it traded at $102 was 18. Okay, and that's far less than Taco Bell or any of these fast food restaurants, Chipotle, etc. Airline. It is crazy. It was cheaper than so many things that are like value stocks. And the final piece is grow or die. It's important to be part of growth, because growth will be the black hole that sucks in all the money, gets all the valuation as we go forward. So with that, everybody, let me know what lessons you learned below. And if you like this, and again, Charlie Munger is a stud for working at 99, and Warren Buffett is a legend. But I believe their portfolio allocation is very flawed today. And based on the growth prospects of these companies, Berkshire Hathaway will suck over the next 5 years. Not that it hasn't sucked over the past 20, as you can see. It's underperformed the S&P as well. That's not what you want if you want to get ahead. As I say, you got to smash 14% to just tread water. That's the nature of the game, everybody. Thank you all for being here. I'll see you all tomorrow.